In a pivotal moment for the cryptocurrency landscape, BlackRock has launched its first tokenized money market fund dubbed the BUIDL Fund, which is expected to bridge traditional finance with blockchain technology. This innovative fund allows investors to trade high-liquidity short-term debt instruments as cryptographic tokens on various blockchains including Ethereum and Solana. The launch represents a significant institutional move into the crypto space, marking a step toward mainstream financial acceptance of blockchain-based products. The BUIDL fund has already shown impressive momentum, skyrocketing from $667 million to $1.8 billion in assets under management within just 3 weeks. As of March 31, 2025, it continues to attract capital inflows, with a growing number of investors opting to park funds in this tokenized offering. In the years since BUIDL's launch, we've experienced significant growth in demand for tokenized real-world assets, said Carlos Domingo, CEO and co-founder of Securitize, the firm collaborating with BlackRock to deploy BUIDL on the Solana blockchain. This shift reflects a broader trend where institutional investors are increasingly looking to blockchain technology for more efficient financial solutions. The BUIDL fund operates by allowing investors to buy and sell tokens pegged to the dollar, which pay dividends daily as new tokens are issued monthly. This structure not only provides investors with yield generation but also offers enhanced liquidity and access to financial products that were previously constrained by traditional operating hours. The ability to trade 24/7 on decentralized networks significantly improves capital efficiency compared to conventional money market funds. Moreover, the introduction of BUIDL serves to legitimize the cryptocurrency ecosystem, as regulated institutions can now confidently engage with blockchain technology. This move could potentially catalyze a new wave of institutional investment, encouraging more traditional finance players to explore blockchain opportunities. However, the BUIDL fund is not without its challenges. Potential risks include liquidity issues, technical vulnerabilities associated with smart contracts, and the inherent volatility of the cryptocurrency market. As traditional finance continues to evolve, the BUIDL fund exemplifies how blockchain can be integrated into established financial practices, offering innovative solutions to enhance efficiency and transparency. It signals a future where institutional-grade products are seamlessly adopted in the crypto space, further legitimizing the industry. The growing interest from both conventional financial institutions and blockchain-native entities indicates a promising trajectory for the fusion of these two worlds. Looking ahead, the continued success of the BUIDL fund could pave the way for more tokenized financial products, enriching the investment landscape for both individual and institutional investors alike. As this trend gains momentum, the implications for the broader financial ecosystem could be profound, potentially redefining how financial assets are traded and managed in the digital era. Bitcoin, the world's leading cryptocurrency, is once again at the forefront of financial discussions as it faces significant price volatility against the backdrop of President Donald Trump's newly announced trade tariffs. Following a sharp decline that saw Bitcoin's value drop below $82,000, investors are left questioning whether a crash is imminent. Recent predictions from industry experts, particularly Tracy Jean, chief operating officer of the crypto exchange MEXC, suggest that Bitcoin could fall to a range of $52,000 to $56,000 by the summer of 2025. This potential downturn is rooted in escalating trade tensions and shifting investor perceptions regarding Bitcoin's viability as a safe haven asset. The recent price drop coincided with a broader market sell-off triggered by Trump's announcement of sweeping trade tariffs, which have been referred to as Liberation Day measures. These tariffs, which impose a global baseline import tax of 10% and even higher rates on goods from several countries, have unsettled investors across various markets. On Thursday, April 3, Bitcoin dropped below $82,000 amid a sharp decline in stock indices, Jean noted, highlighting the panic that swept through the cryptocurrency market as investors sought to mitigate losses in response to the unfolding situation. This week alone, approximately $293 million in long positions and $220 million in short positions were liquidated within 24 hours, a clear indicator of the heightened volatility that has accompanied the news. As the situation develops, uncertainty looms, particularly as Trump's administration is known for its unpredictable approach to economic policy. The interplay of trade negotiations, retaliatory tariffs, and Trump's active commentary, often disseminated via social media, adds to the market's turbulent atmosphere. Despite Bitcoin's recent decline, Gene points out a potential silver lining. Cryptocurrency prices are supported by the weakening of the US dollar and a slight recovery of the S&P 500. Historically, a weaker dollar has bolstered Bitcoin's appeal as a store of value, and a recovering stock market could enhance risk appetite among investors. However, the tariffs have raised concerns about a slowdown in the U.S. economy, which could prompt the Federal Reserve to reconsider its interest rate strategy. The slowdown in the U.S. economy due to the introduction of new tariffs may push the Federal Reserve to resume the cycle of interest rate cuts, Gene explained, indicating that this shift could have mixed implications for Bitcoin's value. Maxim Sakharov, co-founder and board member of WeFi, further elaborates on the complexities surrounding Bitcoin's current position. He notes that the tariffs could be interpreted as more of a negotiation tactic rather than a definitive strategy that will have lasting adverse effects on the economy. However, the looming fiscal debates around issues such as the federal budget and debt ceiling could further exacerbate market anxiety, complicating Bitcoin's trajectory amid these macroeconomic challenges. The narrative of Bitcoin as a digital gold has been a cornerstone of its appeal, especially during times of economic uncertainty. Yet Gene warns that this perception may be waning, stating, "In its current state, the market is easily manipulated. This carries the threat of new disappointments for retail and institutional investors, which will lead to a further increase in the correlation between Bitcoin and gold." As Bitcoin's performance increasingly mirrors that of traditional assets, its status as a safe haven may be called into question, potentially prompting significant capital outflows from Bitcoin exchange-traded funds (ETFs). Looking ahead, Gene's outlook remains cautious, forecasting a negative scenario in which Bitcoin could close April at around $76,000 to $78,000, followed by a deeper plunge to the $52,000 to $56,000 range. This prediction hinges on several critical factors, including ongoing volatility from trade negotiations, the economic slowdown prompted by tariffs, and a potential loss of confidence in Bitcoin's safe haven appeal. However, amid the gloom, there is a flicker of hope. Gene suggests that supportive regulatory changes from the Trump administration could catalyze a rebound in Bitcoin prices, as was seen after the 2017 Tax Cuts and Jobs Act, which spurred a surge in risk assets. If the administration were to pivot towards favorable policies for the cryptocurrency market, Bitcoin could see a significant uplift, potentially reaching values between $100,000 and $120,000. As investors navigate this uncertain landscape, strategies vary widely. Beginners may find dollar cost averaging a practical approach to mitigate volatility, while seasoned traders should closely monitor key support levels and Trump's social media updates for market signals. Long-term holders of Bitcoin may choose to weather the storm, banking on the cryptocurrency's enduring value. The question remains, will Bitcoin crash, or is a recovery on the horizon? The predictions of a decline to the $52,000 mark reflect a perfect storm of trade tensions, economic slowdown, and shifting investor sentiment. Yet the potential for a resurgence, possibly driven by changes in regulatory stances, offers a counterbalance to the prevailing bearish outlook. With the market poised at a critical juncture, all eyes will be on both Bitcoin's price movements and the broader economic developments in the coming weeks. Bitcoin BTC, the world's foremost cryptocurrency, is once again at the center of financial discourse as global markets react to a series of trade tariffs announced by U.S. President Donald Trump in early April 2025. Amid these economic shifts, Bitcoin's price has plummeted below $82,000, prompting urgent questions from investors about its stability and future trajectory. Tracy Jean, the chief operating officer of MEXC, has offered a stark prediction: Bitcoin could fall to between $52,000 and $56,000 by summer 2025, influenced by increasing trade tensions and market volatility. On Thursday, April 3, Bitcoin dropped below $82,000 amid a sharp decline in stock indices provoked by the introduction of unprecedented trade tariffs, Gene explained. The tariffs described by the Trump administration as Liberation Day measures triggered a wave of panic across financial markets, leading to the liquidation of nearly $293 million in long positions and $220 million in shorts within a day. As of April 5, Bitcoin is trading around $83,690. Having experienced a modest decline of 0.19% in recent days. However, the overarching concern remains: why are tariffs crucial to Bitcoin's price dynamics? Although Bitcoin operates independently of direct governmental control, its valuation is closely tied to macroeconomic factors such as the strength of the US dollar and investor sentiment. As Gene noted, a weaker dollar often boosts Bitcoin's appeal as an alternative store of value, while a rebounding stock market can restore risk-on sentiment among investors. The market dynamics are complicated by the potential for economic slowdown. Gene warns that the tariffs could hinder U.S. growth, prompting the Federal Reserve to reconsider its monetary policy. The slowdown in the U.S. economy due to the introduction of new tariffs may push the Federal Reserve to resume the cycle of interest rate cuts, she stated. While lower interest rates could benefit risk assets like Bitcoin, the uncertainty surrounding trade policies poses significant risks. Maxim Sakharov, co-founder of WeFi, noted the current markets are experiencing headwinds as a result of the tariffs imposed by the U.S. administration and retaliatory measures from trading partners. He pointed out that while some market proponents view Trump's tariffs as a strategic negotiation tool, the potential for inflationary pressures complicates the Federal Reserve's rate-cutting outlook. This evolving economic landscape also raises questions about Bitcoin's status as a safe haven asset. Historically dubbed digital gold, Gene cautions that this narrative may be faltering. In its current state, the market is easily manipulated. This carries the threat of new disappointments for retail and institutional investors. The growing correlation between Bitcoin and traditional markets during this turmoil might undermine its appeal as a reliable hedge against economic uncertainty. Gene's bearish outlook suggests that Bitcoin could end April within the $76,000 to $78,000 range, with the looming possibility of hitting the $52,000 to $56,000 mark later in the summer. Such a decline echoes past market behaviors reminiscent of the COVID-19 panic in March 2020, when Bitcoin's price crashed from $10,000 to below $4,000. Despite these challenges, there remains a glimmer of hope for Bitcoin's resurgence. Gene posits that if the Trump administration adopts pro-crypto policies, such as tax incentives or more favorable regulations, Bitcoin could see a significant rebound. A return to January's values of $100,000 to $102,000 for Bitcoin could stimulate a transfer of capital from gold to Bitcoin, she suggested. Adding to the complexity of the current situation, U.S. Treasury Secretary Scott Bessent recently declared Bitcoin a potential store of value akin to gold. As traditional markets falter, Bitcoin's resilience has prompted some analysts to consider it a viable alternative. According to David Hernandez, a crypto investment specialist, Bitcoin's price action this week has been a true testament to its investment case as an emerging store of value. As the financial landscape continues to evolve, Bitcoin's future remains uncertain. While the potential for growth exists, the immediate outlook is clouded by geopolitical tensions and economic pressures. Investors are advised to adopt a strategic approach, particularly in light of Gene's predictions and the broader market sentiment. For those considering entry points into Bitcoin, dollar cost averaging may mitigate risks, while seasoned traders should closely monitor key support levels as market conditions shift. In conclusion, the interplay between Bitcoin's performance and the recent tariffs underscores the fragility of the cryptocurrency market amid geopolitical uncertainties. As April unfolds, the outcome of ongoing trade negotiations and potential policy shifts will be critical in shaping Bitcoin's trajectory. With its dual identity as both a risk asset and a potential safe haven, Bitcoin's resilience will be tested in the months to come. As the cryptocurrency landscape grapples with volatility and uncertainty, Ethereum ETH has emerged as a beacon of resilience amidst broader stock market turmoil. On April 5, 2025, Ethereum was trading around $18-20, showing a modest 1.6% increase as investors navigated a complex market influenced by geopolitical tensions and financial shifts. This resilience is particularly noteworthy given the recent 34% tariffs imposed by China on U.S. goods, which have intensified market fluctuations and prompted capital movements toward alternative assets like cryptocurrencies. In the wake of these tariffs, Ethereum has seen a surge in whale activity, with wallets holding between 10,000 to 100,000 ETH increasing steadily since February 2025. This accumulation trend suggests a bullish sentiment among larger investors, indicating confidence in Ethereum's potential for recovery and growth. Analyst John Morgan has pointed out the formation of a falling wedge pattern on Ethereum's price chart, historically a bullish signal, projecting a possible breakout to $3,200 if the price can close above $1,900. The technical indicators, including a bullish MACD crossover and strong volume-weighted average price VWAP support, further bolster the argument for potential upward momentum. While Ethereum has faced challenges, including a 5% decline amid a recent market correction, its ability to maintain relative stability is noteworthy. The cryptocurrency's correlation with traditional equities, particularly the Nasdaq 100, has diminished, suggesting that investors are diverting capital from conventional markets to hedge against instability through crypto assets. This flight to safety could enhance Ethereum's position, especially if the Federal Reserve maintains its pause on interest rate hikes, encouraging investors to seek better returns in decentralized finance DeFi ecosystems where Ethereum leads. Moreover, Ethereum's performance in the decentralized exchange DEX market has been impressive. Data from March shows that Ethereum reclaimed its status as the most popular smart contract blockchain, handling over $64.6 billion in trading volume, outperforming Solana's $52.6 billion. This resurgence in trading activity reflects an underlying confidence in Ethereum's utility and stability, particularly as investors gravitate toward established platforms during periods of uncertainty. Despite the challenges posed by broader economic conditions, there's a growing sentiment among analysts that Ethereum may be on the cusp of a significant upward movement. As market dynamics shift and the geopolitical landscape evolves, Ethereum's strong fundamentals and increasing network activity could position it for a robust recovery. Market observers suggest that if accumulation patterns continue and global macroeconomic conditions stabilize, Ethereum may soon surpass critical resistance levels and embark on an upward trajectory. Looking ahead, the interplay of cryptocurrency dynamics with traditional financial markets will be crucial. As investors seek refuge from volatility, Ethereum's adaptability and leading role in the DeFi space may drive its demand and market value even higher. With potential macroeconomic shifts on the horizon, Ethereum appears well poised to navigate the challenges ahead and could emerge as a leading asset in the evolving digital economy. In a significant evolution of its cryptocurrency offerings, PayPal and its subsidiary Venmo have announced the addition of two notable cryptocurrencies, Chainlink Link and Solana SOL, to their platforms. This move, announced in a press release on April 4, 2025, is a direct response to user feedback reflecting PayPal's commitment to adapting its services to meet the growing demand for diverse digital currencies. Starting in the coming weeks, users will be able to buy, hold, sell, and transfer Link and SOL directly within their PayPal and Venmo accounts. May Zabata, vice president of product for blockchain, crypto, and digital currencies at PayPal, emphasized the importance of this expansion by stating offering more tokens on PayPal and Venmo provides users with greater flexibility, choice, and access to digital currencies. This allows for more options to buy, send, or spend within our trusted PayPal and Venmo wallets. Chainlink, a leading platform for data and cross-chain interoperability, is widely adopted for its capabilities in enabling developers to create advanced blockchain applications. On the other hand, Solana is recognized for its high throughput and low transaction costs, making it a popular choice for decentralized finance applications, payments, gaming, and more. The addition of these cryptocurrencies aligns with PayPal's broader strategy to revolutionize payment methods and expand its footprint in the evolving digital currency landscape. PayPal first ventured into the cryptocurrency space in October 2020, allowing users to interact with popular digital currencies like Bitcoin, Ethereum, Bitcoin Cash, and Litecoin. This initial step marked a pivotal moment in the company's history. As then CEO Dan Schulman noted the inevitability of a shift towards digital forms of currency. We are eager to work with central banks and regulators around the world to offer our support and to meaningfully contribute to shaping the role that digital currencies will play in the future of global finance and commerce, Schulman stated at the time. The company has continued to innovate since then. In September 2024, PayPal began enabling U.S. merchants to buy, hold, and sell cryptocurrencies through their business accounts, thereby extending its offerings to business owners who are increasingly seeking cryptocurrency capabilities similar to those available to consumers. Jose Fernandez de Ponte, Senior Vice President of Blockchain, Cryptocurrency, and Digital Currencies at PayPal, highlighted the growing demand from business owners, stating, "We're excited to meet that demand by delivering this new offering, empowering them to engage with digital currencies effortlessly." The introduction of Chainlink and Solana comes at a time when the cryptocurrency market is showing signs of maturation, with institutional interest on the rise. The potential approval of Solana ETFs in the United States, anticipated in June 2025, further underscores the growing legitimacy and acceptance of cryptocurrencies in mainstream finance. Major asset managers including Fidelity and Grayscale have already submitted applications for these ETFs, which could lead to increased adoption and investment in Solana through regulated financial products. As PayPal continues to expand its cryptocurrency offerings, it is clear that the company is positioning itself at the forefront of the digital currency revolution. With Chainlink and Solana now part of its ecosystem, PayPal not only enhances its user experience but also contributes to the broader acceptance of cryptocurrencies as legitimate forms of payment. The next few months will be crucial as both the market and regulatory landscape evolve, and all eyes will be on how these developments impact user engagement and the future of digital transactions. As we look forward, the integration of cryptocurrencies into everyday financial activities seems to be more apparent than ever, paving the way for a new era of digital finance.